It is the morning of October 29th, 1929. You are in a kitchen on the third floor of a walk-up apartment on the south side of Chicago. It is still hot. Your name is Margaret Kowalski. You are 38 years old. Your husband died 4 years ago. A factory accident, a small settlement. And then, silence. You have raised 2 children since then on the wages of a seamstress and the careful arithmetic of a woman who cannot afford to make mistakes. Every week for 6 years, you have deposited what you could into the savings account at the neighborhood bank 2 blocks away. Not because anyone told you it was sophisticated, because it was safe. Because the bank was a brick building with brass fixtures and a man in a suit behind the counter who knew your name. The account holds $430. You know the exact number because you wrote it in a small notebook you keep in the kitchen drawer next to the utility bills. $430 is 2 years of discipline. It is your children's shoes for the next 3 winters. It is the deposit on the better apartment you have been promising yourself since 1926. On Thursday morning, you will walk to the bank with your notebook. The brass fixtures will still be there. The man in the suit will still be there. He will not be able to help you. This morning, you do not yet know that the bank will not open tomorrow, and that when it does reopen, weeks later, under new management, under terms you were never asked to agree to, the number in your notebook will no longer correspond to anything you can touch, spend, or use. The notebook will still say $430. The money will be gone. Not stolen, not lost in a fire. Gone in the way that only money can go, quietly, legally, through a process you were never taught to understand and were never warned could happen to people like you. Somewhere in the same city, that same morning, a man is looking at a different kind of asset, not a number in a book, not a promise from an institution, something older than that. Something that does not require a building to remain open in order to hold its value. You do not know his name, you do not know what he holds, but the coffee is still hot, and the bank opens in 2 hours. When a financial system collapses, most people assume the damage is random, the wrong companies, the wrong timing, bad luck distributed unevenly across an unlucky generation. That assumption is wrong. The damage follows a structure. And once you see the structure, you cannot unsee it. Here is what actually happens. Most of the assets you are told to hold, savings accounts, stocks, bonds, real estate, are not things you own outright. They are promises. A savings account is a promise from a bank to return your money on demand. A stock certificate is a promise that the company behind it remains solvent. A bond is a promise that the currency used to repay it will still be worth something when the payment arrives. These promises are only as strong as the institutions making them. And when the system breaks, the institutions break first. The promise breaks before you do. Think about what that means. Your savings did not go anywhere physically. The number in Margaret's notebook did not change. $430, written in pencil, still legible on Thursday morning. But the bank that was supposed to honor that number had already failed. The promise existed. The money did not. This is not a metaphor. Between 1930 and 1933, approximately 9,000 American banks failed. 9,000. Each one represented thousands of depositors who held perfectly valid account numbers attached to perfectly real balances and could not access a single dollar. Not because they had done anything wrong, not because the economy had touched them directly, because the bank between them and their money had collapsed. And in 1933, there was no federal deposit insurance to catch what fell. The Federal Deposit Insurance Corporation did not exist until June of 1933. Before that date, your deposit was not insured. It was not protected. It was a handshake with a building. By the time the Federal Deposit Insurance Corporation was created, the damage was done. Now, look at what happened to the stock market during those same years. The Dow Jones Industrial Average closed at roughly 381 points in September 1929. By July 1932, it had fallen to approximately 41. That is not a correction. That is not a bear market. That is an 89% collapse, peak to trough, in less than 3 years. Families who had put their savings into railroad stocks, industrial companies, bank shares, the most respectable, most widely recommended investments of their era, watched 9/10 of their wealth disappear. The physical companies those stocks represented continued to exist. The factories were still standing. The railroad tracks were still in the ground. The value had gone. Not the buildings, not the tracks, the promises attached to them. What causes a chain like this to break? Not a single shock. Not a single bad decision. A cascade. Bank of United States, New York City, December 11th, 1930. When it failed, one of the largest retail banks in America at the time, depositors at neighboring institutions began lining up the same afternoon. Not because those banks were insolvent, because fear travels faster than solvency. That withdrawal pressure made the next bank insolvent, which triggered the next withdrawal, which collapsed the next institution. Each failure was both a consequence of the previous failure and the cause of the next one. The Federal Reserve, operating under gold standard constraints in 1930, did not expand the money supply to arrest the cascade. It let the chain run. The middle class had no mechanism to stop it. You could not negotiate with a cascade. You could not opt out. You could only watch the number in your notebook stop meaning anything. What do most people conclude from this? That the 1929 crash was a unique catastrophe, a once-in-a-century event, a system failure that has since been fixed by better regulation, deposit insurance, and central bank intervention. And in some ways, those fixes are real, but they address the surface, not the structure. The structure is this. When you hold an asset whose value depends entirely on a system remaining functional, a system you did not build, do not control, and cannot exit, you are not holding wealth. You are holding a promise from that system about wealth. In 1971, the promise changed at the national level. On August 15th of that year, President Nixon announced the suspension of dollar convertibility into gold. The Bretton Woods system, the international agreement that had fixed the dollar to gold at $35 per ounce since 1934, was ended by a single televised address. No referendum, no warning to ordinary dollar holders. The promise that the dollar was backed by something physical, something outside the system, was withdrawn overnight, not stolen. Not defaulted, dissolved. Every dollar-denominated asset in America repriced from that moment forward. Not because the assets themselves had changed, because the promise underlying the dollar had changed. The system had rewritten the terms of its own promise without asking the people who held that promise. This is the pattern. Not 1929 specifically, not 1971 specifically. The pattern is that when systems fail, they fail by breaking the chain of promises that gives conventional assets their value. And that chain runs in one direction. From your savings account, through the bank, through the corporate sector, through the currency itself, all the way to the government's promise to keep the whole structure running. When any link in that chain snaps, the assets above it lose the thing that made them worth something. Not the asset, the thing underneath it. The question is not which crisis will break the chain next. The question is simpler than that. Which of your assets requires the chain to hold and which ones do not? That is the only distinction that has ever mattered. Gold does not require a bank to hold its value. It does not require a solvent corporation. It does not require a government to keep its promise. It is the only major asset class in American history that exists entirely outside the chain of promises that collapses when the system collapses. That is not a romantic claim about precious metals. It is a structural fact with a documented price history. In April 1933, Franklin Roosevelt signed Executive Order 6102. It required every American citizen to surrender their gold coins, gold bullion, and gold certificates to a Federal Reserve Bank at a mandatory price of $20.67 per troy ounce. Then, 9 months later, the Gold Reserve Act of January 1934 revalued gold to $35 per ounce. Overnight, the government had repriced gold upward by roughly 69% against a dollar that ordinary Americans were no longer allowed to convert into gold. The people who had been forced to sell their gold at $20.67 received nothing from that repricing. The government absorbed it. Think about what that means. The gold itself held its value. The people who held gold in their own hands, outside the banking system, outside the system around it, had an asset the government had to confiscate by law. Because it was worth something the dollar was not. When Nixon closed the gold window in 1971, gold was $35 an ounce. By January 1980, it reached approximately $850, a 20-fold appreciation in less than a decade. Not because gold changed, because the dollar's promise changed, and gold had no promise to break. This pattern appears across every dollar stress episode in American history. The country changes its monetary commitment. Gold reprices. The mechanism repeats. One honest limitation. Gold held inside a bank vault is not outside the system. It is inside the system. In a locked room, the government can access with a single executive order, as 1933 demonstrated. Physical gold held privately is a different asset from a gold certificate or a gold exchange-traded fund. The certificate is a promise. The metal is not. Gold needs no institution. But most people cannot hold enough gold to feed a family. The second line of survival is older than gold markets, older than banking, older than the concept of a financial system. It is the ground itself. Productive farmland holds value because it produces food, not because a bank agreed to lend against it, not because interest rates are favorable, not because a real estate market is functioning, because food is demanded every day regardless of what the financial system is doing. That is the only thing underneath farmland's value, and it is the one thing a financial collapse cannot destroy. During the Great Depression, approximately 200,000 farm foreclosures were recorded in 1933 alone. 200,000 families lost their farms. But look at who lost them, the leveraged ones, the farms with mortgage debt transferred to the banks that held the debt. The debt was the vulnerability, not the land. Families who owned their farmland outright, no mortgage, no bank involved, continued farming. Continued producing, continued eating. The land fed them whether the financial system was functioning or not. You could not eat a railroad stock certificate. You could not eat a savings account balance. But you could eat what grew in the ground. Fast forward to 2008. The Standard & Poor's case. Schiller National Home Price Index fell approximately 33% from its 2006 peak to its 2012 trough. In Phoenix, Las Vegas, and Miami, the collapse reached 50 to 60%. Residential real estate, the asset millions of middle-class Americans had been told was the foundation of their financial security, collapsed because it was built on a foundation of mortgage availability, bank solvency, and employment income. When all three failed simultaneously, the houses kept standing and the values fell off a cliff. During those same years, United States farmland tracked by United States Department of Agriculture data held broadly stable, and in many regions appreciated. The same category. Land. Two entirely different outcomes. One type needed the financial system to hold its value. The other needed only soil and rainfall. Agricultural land cannot hide. Governments know where it is. They can tax it, regulate it, seize it under eminent domain. The limitation is real, but it cannot be made worthless by a bank failure. That is the distinction. Both gold and land exist outside the banking system entirely. But there is one asset that exists inside the system and can still protect you, under exactly one condition. Short-duration government debt and cash held outside failed banks can preserve and even increase your purchasing power during one specific type of collapse. Deflation, not all collapses, one specific type. If you do not understand the type of crisis you are in, this asset will not save you, it may destroy you. Between 1929 and 1933, the United States experienced deflation of approximately 27%. Prices fell. Everything got cheaper in dollar terms. A dollar holder who kept cash outside a failed bank and survived the banking cascade intact saw their purchasing power increase by roughly 37% in real terms as the deflated price level adjusted. The cash did not grow. The world around it shrank. The result was the same. More purchasing power than the year before. But now look at Germany between 1921 and 1923. The mark depreciated from 4.2 marks per dollar in 1914 to 4.2 trillion marks per dollar by November 1923. A German family holding paper savings, the most responsible thing a middle-class German family could do, was wiped out completely, not damaged. Not reduced, wiped out. Their savings bought less than a postage stamp by the time the hyperinflation peaked. Same asset. Cash. Two different crises. Two completely opposite outcomes. The cash is not the variable. The type of collapse is the variable. In a deflationary collapse like 1929, cash outside a failed bank gains power. In an inflationary collapse like Weimar Germany, cash is the first thing to die. You need to understand which environment you are in before this asset means anything at all. That gradient, from no system dependency to partial system dependency, leads directly to equity. Not all equity, a specific kind. Equity in companies that produce essential things, energy, food, water, basic infrastructure. These companies are not immune to collapse. Nothing that touches the stock market is immune. But they are structurally more resilient than financial equity, because the revenue base does not disappear when the credit markets freeze. During the 1929 to 1932 collapse, the broader Dow Jones Industrial Average fell approximately 89%. But utility stocks, tracked by the Dow Jones Utility Average established in 1929, declined significantly less. Several utility companies maintained dividend payments into 1931 before the Depression's full depth made that impossible. They were not survivors in the absolute sense, they were relative survivors. And in a collapse, relative survival is the difference between recovery and permanent loss. In 2008, the Standard & Poor's 500 financial sector fell approximately 55%. Energy and agricultural commodity equities fell significantly less during the acute phase of the crisis, not because the crisis spared them, because their underlying revenues were anchored in things people could not stop buying: fuel, food, electricity, rather than in financial products whose value depended entirely on the credit system that was collapsing. The limitation here is direct. These are still equities. They still trade on exchanges. They can still be sold into a panic. They can still fall 40 or 50% in a severe enough crisis. The resilience is relative, not absolute. What you are buying with essential infrastructure equity is a lower degree of system dependency, not zero. But lower is not nothing. In a collapse where everything falls, what falls least is what matters. 4 assets down, each one less system dependent than what the middle class was told to hold. The 5th is the one nobody talks about, because it does not appear on any brokerage statement. Physical goods with direct immediate use value, stored food, fuel, functional tools, productive equipment, these hold exchange value in every economic environment humans have ever created. Not because a market exists for them, because people need them whether a market exists or not. During the early 1930s, documented barter exchanges emerged across American cities. In Seattle in 1931, the Unemployed Citizens League organized a direct exchange network. Labor and physical goods traded without dollars, without banks, without any of the system that had just collapsed. Participants who had physical goods to trade maintained access to food and services. Participants who had only dollar balances in suspended bank accounts had nothing to trade. Federal Writers Project oral history collections from 1936 to 1940 document multiple accounts of rural Midwestern families who effectively stopped using cash during 1932 and 1933. Not because they chose to, because cash was unavailable and they did not need it. They had stored grain, they had livestock, they had tools. The financial system collapsed around them and their daily lives continued. Because their assets did not require the financial system to deliver their value. The limitation is obvious. You cannot retire on stored grain. You cannot build long-term wealth from physical goods inventory. This asset category is not a wealth-building strategy. It is a crisis floor. The thing that keeps you functional when every other asset has been frozen, devalued, or made inaccessible. It is the last line before zero. But zero is where the middle class ends up when every asset they hold requires the system to function. 5 structural properties. 1 conclusion. None of these assets requires the financial system's permission to be worth something. Gold holds value without a bank. Productive land feeds people without a mortgage market. Cash preserves purchasing power in deflation without a solvent institution behind it. Essential infrastructure produces revenue without functioning credit markets. Physical goods trade without currency. The system can break completely. These 5 things remain. It is 1935. You are Margaret Kowalski. You are still on the south side of Chicago, still in the same apartment, though the rent has been renegotiated twice because the landlord had no other choice. The notebook is still in the kitchen drawer. It still says $430. You have not thrown it away. You are not sure why. The bank reopened in 1934, under new management, under the terms of a reorganization you were never consulted about. You recovered a portion of what was frozen, not all of it, not close to all of it. The children have shoes. You are still working. The arithmetic is tighter than it was in October 1929. And it was already tight then. You did not lose everything. You lost the margin, the 2 years of discipline that were supposed to become the deposit on the better apartment. The small cushion between you and the next emergency. That is gone, not stolen, not lost in a fire. Gone through a process you still do not fully understand, conducted by banks and officials you had trusted completely. What you understand now, in 1935, looking at that notebook, is something you could not have articulated in October 1929, when the coffee was still hot and the bank was about to open. You understand that the brass fixtures were never the building's value. The man in the suit was never your protection. The number in the notebook was only ever a promise, and the promise was only as strong as the institution keeping it. Somewhere in this city, in 1929, there was a man who held something that required no institution to keep its promise. He is not richer than you because he was smarter. He held a different kind of asset. That is the only difference that ever existed. This channel does not predict the next collapse. It documents the ones that have already happened, so the structure becomes visible before it becomes personal. If that kind of clarity matters to you, subscribing is the most direct way to stay close to the pattern. The system does not fail the people who ignored it. It fails the people who believed in it.